Banks are the backbone of modern economies, providing essential services such as loans, deposits, and payments. However, banks are not immune to failure, and when they do collapse, it can have severe consequences for the economy and people's lives. Understanding the reason behind bank failures is crucial to safeguarding our financial system and preventing similar catastrophes in the future. One of the main causes of bank failures is inadequate risk management. Banks that engage in risky lending practices, such as subprime loans or excessive exposure to a single sector, are vulnerable to economic downturns that can cause defaults and losses. Moreover, banks that lack proper risk management procedures, such as stress testing or diversification, are at high risk of failure. Another reason why banks fail is due to fraud or mismanagement. Banks that engage in unethical practices like insider trading, embezzlement, or accounting fraud can cause severe harm to their reputation and financial stability. Moreover, banks that are poorly managed or have a weak corporate culture can make decisions that hurt the bank's long-term prospects, such as making loans to uncreditworthy borrowers or investing in risky assets. Banks can also fail to external factors such as economic crisis or natural disasters. When there is a sudden downturn in the economy, such as the 2008 financial crisis, it can cause a domino effect that leads to bank failures. Moreover, natural disasters like hurricanes or earthquakes can damage bank assets, leading to losses and instability. Regulatory failures can also contribute to bank failures. Governments create regulations to protect consumers, ensure financial stability, and promote fair competition. However, when regulators fail to enforce regulations or create loopholes that banks can exploit, it can lead to risky behaviors that causes bank failures. Moreover, regulatory failures can occur when regulators don't have the necessary expertise or resources to oversee the banking industry effectively. Recent bank failures, such as the collapse of SVB and Signature Bank, serve as a stark reminder of the need for vigilance in the financial sector. In these cases, poor lending practices, weak risk management, and external shocks all contributed to the bank's downfall. The banks had significant exposure to high-risk loans in the commercial real estate sector, and when the market experienced a downturn, the value of these assets plummeted, leaving the banks with non-performing loans and a deteriorating capital base. At the same time, the banks faced external shocks in the form of regulatory changes and economic turmoil, which further strained their financial position. To prevent similar failures in the future, banks and regulators must work together to strengthen risk management, improve corporate governance, foster resilience to external shocks, and implement responsible lending practices. By continually assessing and managing their risk exposure, maintaining transparency, accountability, and oversight, and adhering to responsible lending standards, banks can reduce the risk of loan defaults and protect their balance sheets. In addition to preventive measures, governments have implemented deposit insurance schemes to safeguard depositors' funds in case of a bank failure. Furthermore, regulatory bodies have implemented stringent oversight and monitoring the banking industry to ensure that banks adhere to regulations and adopt prudent practices. Additionally, regulatory agencies have raised the level of transparency and disclosed required from banks to provide investors and the public with comprehensive information about their activities and exposure to risks. Bank failures can have severe consequences for the economy and people's lives, but by understanding the root causes of bank collapses and implementing measures to address these issues, we can create a more resilient financial system that supports economic growth and stability for all. Safeguarding our financial system requires a collective effort from all stakeholders, including banks, regulators, investors, and the broader public. By working together and mitigate risk and strengthen our financial institutions, we can create a more stable and prosperous future. If you enjoyed our video, make sure to give it a thumbs up and subscribe to our channel if you still haven't. Thanks for watching, I'll see you in the next one.